Hey everyone, welcome back to the Arca monthly market call. It's middle of November 2023. Because this is a new series, I just want to provide a little context here before we get started. I'm Jeff Dorman, Chief Investment Officer at Arca. I'm joined by my partner Nick Holtz, one of the research analysts at Arca. The reason we want to do this is I worked at Lehman Brothers in the early 2000s, back when it was actually a prestigious firm. And Lehman Brothers was a very big, well-known fixed income investment bank. And at the time, the internet was fairly new. Data extraction was pretty difficult. The fixed income market was really only known to a select few. The majority of market participants didn't know much about fixed income. And we had a gentleman by the name of Rick Reeder, who was the head of fixed income at the time at Lehman, and he's actually now the CIO at BlackRock. And he did a weekly market call every Tuesday morning, filled with a lot of charts from Bloomberg, a lot of data that the common investor didn't really even know how to access or even how to find. Shout out to his research analyst, Arthur Tidievsky, wherever he is now, really did a great job of providing charts and background information as to what made the fixed income market tick. And I found it tremendously helpful when I was a young analyst. I also found out, decades later, that this was one of the most watched market calls at the time. I mean, everybody tuned in at the same time on Tuesday to hear what Rick Reeder had to say about the fixed income markets. So you fast forward to today, and I think crypto is actually in a very similar place to fixed income in the early 2000s. There's a ton of data out there. Most people don't know how to extract it. Most market participants don't even really know necessarily where to find it. But I think we're at the point now where most of the people who care about crypto are savvy enough to really understand the nuances versus 3 to 5 years ago, when investing in digital assets was really more of a leap of faith. So we hope these monthly calls can help educate investors not only about what's happening in the digital asset market on a month-to-month basis, but also kind of how to find this information yourself, what to look for, where the data is coming from. Really, this is more for those who are not really necessarily beginners, but want to get a little more deeper into the market. So, before we kick things off, quick disclaimer: this commentary is provided as general information only, and is in no way intended as investment advice, investment research, a research report, or a recommendation. Any decision to invest or take any other action with respect to the securities discussed in this commentary may involve risk not discussed herein, and such decisions should not be based solely on the information contained in this document. So let's talk about where we are in the market right now. So I love this graph here. The Bloomberg Galaxy Crypto Index is one of a few digital asset indices out there, and all of them have different makeups. The Bloomberg Galaxy Crypto Index happens to be pretty large cap focused. It's still heavily weighted with Bitcoin and ETH, but also contains a lot of other large caps as well. I think this is a really interesting chart because, you hear a lot about trading in crypto. And of course, there are a few, select great traders who are great at getting long and short at the right time. But the reality is most investors are looking from a long bias standpoint. And the reason is because of reasons like this, right? If you miss any short-term rally, you really get left behind, right? It can be really expensive. I think this is really interesting because over the last 16 months, you've probably heard nothing but doom and gloom about the digital asset markets. There's been way more down weeks and down months than there have been up weeks and up months. And a lot of people have been waiting for a better entry point. Some have even tried to recuperate the 2022 losses by shorting and trying to squeeze a few more drops from the lemon. But within this last 16 months, there's been three really big upticks. The first was July 2022, right after the Luna and Three Arrows meltdown. The other was January 2023, after a little bit of a Santa Claus rally and some window dressing that happened at the end of the year in December of 22 post FTX. And now, of course, October 2023, which was a pretty big month on the uptick here for digital assets. These 3 months have erased all of the losses over the last 16 months. So again, using the Bloomberg Galaxy Crypto Index, as you can see here, the blue line includes everything, includes all 3 of those months I just mentioned. And you can see the cumulative return through the end of October was about 52, a little over 52%. But if you excluded those 3 months, you're looking at a loss of 37.5%. So that's really a really big differential there by just missing, a handful of weeks out of the last 16 months. So, the market has a long way to go to before it recoups all of the losses from 2022. Don't forget, most of the losses happened in the first half of the year, not the second half. But it just shows you that, even though it's been negative sentiment, the sentiment doesn't always match price action. And it's really hard to stay out of the market when you can have fast periods like that. So moving on here, one of the things we're trying to do here is compare where we are today versus other market cycles. This is a chart of 2019 to 2021. You can see the bull cycle here. In 2019, you basically came off of one of the worst years ever in 2018. And what happened first is the very beginning of 2019, you had a really fast move higher as sentiment bottomed. And really kind of everything went higher, including small caps, including some tokens that maybe didn't warrant going higher. And then that petered out around May, June of 2019, where you had a kind of a little bit of too much euphoria and everything started to crash except for Bitcoin. And Bitcoin there, you can see the blue line there. Bitcoin really substantially outperformed in the second half of 2019. And then ultimately what happened is because Bitcoin performed so well and everything else had sold off so much, there was a little bit of a catch up, right? Everything else, Ethereum and some other tokens were really oversold. And you started to have a pretty big catch up. And ETH started to really gain adoption. And then ultimately that led into 2020 and 2021, where DeFi started to get hot. And then you had layer ones like Solana and Avalanche and Luna go crazy. And then ultimately, that went into NFT mania and things like that. So you're looking at basically a 2.5 to 3 year cycle here. If you look at where we are today, it actually looks very similar. Basically, we had the first 3 months of 2023 where, again, we came off the 2022 FTX lows and everything really ripped higher to start off the first 2.5 months of the year. And then if you go from just April 1st of this year to basically September 30th, pretty much everything except for Bitcoin really sold off pretty hard. There was a handful of winners here and there. It's really been a kind of a token pickers market. There's things like Chainlink and ThorChain and a few others, Rollbit that performed well. But for the most part, it's been Bitcoin for the last 6 months, starting with the March regional banking crisis all the way to September. And what happened? Bitcoin substantially outperforms. All of a sudden, everything else looks oversold, and you start to play catch up. And that's what we've really seen over the last 30 days, not just with Ethereum, but things like Solana, some of the gaming tokens, things like IMX. It's really been a fast, violent catch up. So, does this mean we're for sure going to then head into 2024 and 2025 similar to what we did in 2020 and 21? Obviously not. But I do think that it's pretty shocking how these cycles have played out pretty much to a T in a 4-year cycle. So before we kind of get into a little bit more on digital asset specific, we'll get into a little bit of what's going on in the macro world. And Nick, tell me if you're wrong here, but I think for the most part, 2022 was very macro driven across the entire digital asset market, whereas I would say now most of what we're talking about here from a macro standpoint is really affecting Bitcoin probably more so than other areas of the market.
Yeah, definitely agree there. It's really interesting to see that comparison, and the ETF has definitely been a driver, and we'll get into that a fair bit more of Bitcoin's outperformance. But I really think the macro has been a driver of Bitcoin as well. This was something that I had seen circulating a bit, looking at some of the returns of all these other fiat currencies relative to the US dollar, and just negative across the board. I mean, you've seen the dollar really, really outperform, and just show that people are looking for safe havens. But at the same time, things like gold haven't really outperformed. Over the longer term, though, you look at something like Bitcoin. I mean, Bitcoin is up 20,000% or whatever over this time period. You look at bonds also down. So this narrative of the store of value, I think, has been kind of increasingly permeating the consciousness of more traditional investors, and that you've seen that reflected in the price of Bitcoin. Going forward too, this has kind of come out of the crypto space, but also in the traditional space as well. The greater focus on the U.S. debt and global debt, really. With interest rates rising, you have this debt, which a lot of people have been talking about for decades as being a problem, really start to come into focus, because the problem with the debt isn't the debt itself, but it's when you have to pay really high interest expenses on that debt, you can't allocate that money to other things like funding, other sorts of government spending, military spending, or social security, or all these different things. So when that happens, you typically see an inflation of the currency, and people move to these more safe haven assets that are outside of the kind of government's ability to spend them. So just this narrative also increasingly kind of contributing to Bitcoin over the past 6 months.
Yeah, absolutely. And I think you can see it in the we didn't put a chart in here as well, but you can see it in the CDS market. A US 5-year CDS as of this morning was around 51 basis points, and that's significantly higher than other of the G7 countries, and also just interest alone, right? I mean, this is largely a U.S. problem right now. It's been a long time, since we've seen interest rates in other countries significantly lower than here in the U.S. And I think that's a pretty telling for Bitcoin, at least specifically, why there's a little bit of a bid going into Bitcoin here, as the U.S. is clearly on an unsustainable path with both debt and interest.
Yeah, and the last thing there, I mean, that only gets worse over the next couple of years. I mean, there's the need to refinance a lot of this debt, not just in the U.S., but Europe, Japan, China, through 2025, 2026. Just increases, and I think that increasingly becomes a focus.
Absolutely. So, sticking with Bitcoin here for a minute on the next slide, I think one of the big drivers, and we talked about this last month as well, but one of the big drivers of Bitcoin strength, in addition to the macro, is obviously these expectations of an ETF. I'd say the market at this point has 100% priced in a positive outcome that there will be an ETF approval for Bitcoin at some point here, most likely by January, but the actual timing is certainly uncertain. But this is a good way to see kind of how that probability has increased over time. This is a graph of the Grayscale Bitcoin Trust. And for those who are pretty well aware of the history here, it traded at a significant premium to the net asset value back in 2018 and 19 and 2020, because there really was no other way to get access to Bitcoin. And then it traded at a huge discount to the net asset value towards the end of 2021 and also into 2022 and early 23. That has really been narrowing. And the reason for that is that there is just high expectations that when an ETF gets approved, that Grayscale will be able to convert its trust into an ETF as well. And the market is just clearly betting on that, right? So, and this is something that doesn't really show up in the inflows, because this doesn't, when you see buyers of GBTC on the open market, that doesn't actually make its way into the Bitcoin market, right? That doesn't add new demand to Bitcoin. So by seeing this is just more indication that there's even more demand out there right now for Bitcoin than you're seeing in price. So if you actually do add a new vehicle where there will be real inflows like an ETF, it certainly could show quite a big increase in price from those new inflows that are coming. And if you look at the next slide as well, you can see some of where that inflows is coming into. So on the left there, this is provided by CoinShares. You can see just the inflows that go into ETPs and other non-US ETFs. You can see that it's really been mostly a year of net outflows, with a couple of sprinkles of inflows here and there. The bigger one in the middle there being around March with the regional banking crisis. But you can see just in the last 4 weeks here, there's been over 750 million of new money coming into various Bitcoin ETFs and ETPs, and that's before we even have the ETF approval. And if you look over on the right, you can see that's the CME. It's a little hard to see there, but you can see that the CME being largely a place where non-crypto native investors are expressing views. CME Bitcoin futures volume is at all-time highs, open interest is at all-time highs, and the CME's percentage of overall futures trading is at an all-time high, taking market share away from Binance and some of the decentralized exchanges. So basically what we're saying is we're seeing an increasingly large interest from institutional investors, specifically into Bitcoin. And that is driving some real flows into the market. And obviously, for those who are crypto native and own a lot of everything, they're selling some of that Bitcoin into this bid and then rolling down into your Ethereums and some other places. So speaking of Ethereum, I know this has been Bitcoin heavy, as it really has been for most of the year. Looking at the next slide here, I thought this was a really interesting chart, and courtesy of Caleb and Brown, they actually had a pretty big report out there that is worth looking up. But this slide in particular, Ethereum has just surpassed $10 billion in revenue. And this is obviously one of the biggest differences between a smart contract protocol like Ethereum versus a cryptocurrency like Bitcoin. Bitcoin doesn't really create revenues, right? The miners, right, they can become profitable for Bitcoin, but Bitcoin itself is creating very little in the way of revenues. Ethereum, on the other hand, is creating quite a bit in terms of revenues. And you can see that whether you can see this chart or not, depending on your screen, Ethereum is basically reached $10 billion of revenue in the first 7 years. That's faster than every major company other than Google. I think Google is the only one that got there faster, but pretty much every other large tech company, it took 10 to sometimes 20 plus years. I think Microsoft was almost 30 years before it surpassed $10 billion in revenue. And this is really important in terms of not just the speed with which blockchain is taking off, but also in terms of how Ethereum works and who actually gets that money. So Nick, why don't you dive into a little bit more here on where this revenue actually goes to, and the difference between some of these tech companies where obviously it just goes to shareholders and the owners and creators of the company.
Yeah, and I think that's a kind of critical driver of why it's happened so fast. I mean, you have here a permissionless network where essentially the revenue is coming from people who built businesses on top of it and are, incentivized to compete with each other and to try to create profits, and all that is getting handed back to Ethereum, the network, which is essentially comprised of people who hold ETH and are staking ETH and are validating, providing a service to Ethereum, the network. So you have this kind of synergistic relationship between people developing on the network, people using the network, and the people who own or stake within the network, all providing usefulness to Ethereum as an entity, where you don't really have that in a tech company, where it's people working together in a company and then providing a service to users, but without that kind of competitive aspect within the company itself.
Yeah, absolutely. And I've always used the analogy that to me Ethereum was more like the Amazon store or more like the Apple App Store, in that it creates a service for everyone to build upon, and as a result, to be able to do that, but to think about every time you use the Apple App Store, every time you shop on Amazon, you're not creating anything for the other users of the platforms, right? You're creating it for just the creator of Apple or Amazon itself, or in the case of the apps themselves, right? But there's a lot of revenue that is moving around there that only a handful of people are really benefiting from. And here you have Ethereum, as Nick said, an open source protocol where all of this revenue is actually going to the community members. It's pretty powerful. And if this continues, not just for Ethereum, but for their smart contract protocols as well, certainly this is kind of the ethos of what a lot of people in digital assets, including ourselves, the reason that we're in here. So speaking of Solana and some others, we promised at the beginning here that we were going to get a little more into the weeds, a little nuance. I know the first few slides here were a little bit more high level macro, but kicking it over to some of the other tokens and some of the other ecosystems. Nick, what's happening with Solana and basically the non-Bitcoin, non-Ethereum world?
Yeah, so I mean, taking it back to the beginning of the year, obviously Solana was pretty bummed out ecosystem after the FTX stuff, and has really caught a lot of positive sentiment from the community. I think that there is a very strong developer community that people see there. We've had this really big rally recently in Solana, and the title maybe comes off a little bit more negatively than we see it here, but you have a lot of really talented developers, a lot of encouraging tech going on in Solana, but you really haven't seen it reflected in the usage recently. So you've seen price really move ahead of that and start to anticipate really big things coming out of Solana. You had the recent conference just over the past week making some major announcements. One of the big things is their Fire Dancer, which is a client that makes Solana. So Solana already runs 1,000. It's really bringing that up another order of magnitude, getting you to the point where you can run like a Visa network, that kind of order of magnitude of speed and of capacity on Solana. Seeing a lot more interesting things around decentralized physical infrastructure networks, DPIN we call it, which are more of networks where they bridge into the real world. Things like Helium and Render, which are wireless networks or networks for rendering graphics cards, and creating like rendering movies on chain. All these things you can do on Solana that just aren't possible in other crypto, within other crypto ecosystems. So just seeing the community sentiment really shift here and start to reflect those increasing growth expectations here with Solana.
Yeah, I think there's a school of thought that, again, if you're going to stick with this 2019, 2020 type parallel, Bitcoin went up almost 20x from the lows of 2019 to the highs of 2021. But Ethereum went up about 40x, right? And at the time, the price of Ethereum was definitely outpacing its TVL, outpacing the apps that were built on it. But ultimately, even coming out of the bear market, Ethereum solidified itself as being, a clear second banana to Bitcoin in terms of not just market cap, but also just how much activity, how much knowledge base and developer traction that ecosystem was having. And a lot of people think Solana might be the same thing here, right? So, not just the price appreciation alone, but that Solana could end up being a significant player here with its ecosystem, with its apps. So, not, I guess, all that surprising that price would be getting ahead of some of the fundamentals here. And of course, it's a little bit of a reflexivity as well, right? The higher the Solana price, that actually does boost the TVL and everything else because, we convert these things back to dollars. So I guess not entirely surprising, but it'd be interesting to see if the Solana fundamentals also ultimately do back up the price action thus far.
Yeah, and it's interesting you make the comparison between Bitcoin and Ethereum too. I think going on to the next slide, there is kind of that comparison where they are similar, but it's also differentiated in a way. And so this is just an example of how people use Solana differently than they use Ethereum. Ethereum is really seen as this kind of composable settlement layer, and you can see it's maybe more difficult, but in the top right, 83% of stablecoin transactions on Ethereum are over $10,000. So really higher value, store of value type transactions. Whereas on Solana, you're talking about just 35% of them, or sorry, 68% of them being under $100. So much smaller value transactions. You can do all sorts of things like gaming, or as I mentioned, the DPIN. These are all things that require kind of microtransactions, payments being another one, that are just like different use cases. It is the same kind of similar fundamental technology, but the cheapness, the speed of Solana, versus kind of the guaranteed security that people really trust and believe in for Ethereum, just provide you different avenues, different use cases between the two different chains.
Sure, and a shout out to Flipside Crypto there for the data underpinning that chart. So, you're talking about Solana versus Ethereum here. You're talking about some stablecoin transactions. One of the things that happened in 2021 was, a real race to fill block space because, basically Ethereum, the demand for Ethereum with the rise of stablecoins and DeFi and ultimately NFTs was really too much for the block space of Ethereum. As a result, you had all these other layer ones and eventually layer twos coming online. And then, of course, we hit the bear market where transaction volumes dried up, activity dried up, and now we have a dearth of block space, or rather, a dearth of demand relative to the amount of block space. So what does that mean for L2s? What does that mean for the rest of the kind of, protocol, smart contract protocol layer?
Yeah, I mean, it's definitely a tough environment. In the past, we saw these layer twos, Polygon, Optimism, and Arbitrum kind of being the only games in town, really. And there was a hypothesis that maybe they would be able to maintain that market share. But what you've really seen is with the kind of lack of demand for filling the block space, as you mentioned, that and a lot of competition coming up, that it's been really difficult for them to compete. So we've just got 5 different layer twos on here, but there's a bunch of others that you could include, things like Scroll, Aztec, ZK Sync. There's a whole host of others either that have already launched and have some traction, or haven't launched and could potentially have traction going forward, where this environment has gotten much tougher than it was, say, in mid 2021, where for the layer twos, their business model is to get users on chain and to pay fees to the layer two. And now what you're seeing is just a lack of users, but a ton of different competition, a ton of different competitors within that space.
Yeah, and I think ultimately we need to see in the upcoming years here kind of a super cycle of applications, just like we saw the super cycle of infrastructure 3-4 years ago. I think we talked at length already about the rise of DeFi applications, everything from trading applications to lending and borrowing to even insurance, and then ultimately the rise of stable coins, which continues to rise, as well as the rise of NFTs. We're looking for new sectors and new themes that are probably going to take us to the next level. Those that are probably, probably in future slide decks, we'll get into things like artificial intelligence, real world assets, maybe even gaming, some of the things where price action is telling you right now that there's going to be significant application growth in the future. But what about some of the older ones I just mentioned? Like what's happening with, say, NFTs?
Yeah, I mean, NFTs, it has been a really tough environment. Historically, what these have looked like is kind of just the profile picture NFTs that we know from early to mid 2021, or sorry, 2021 and 2022 timeframe, really. And so just traders of these NFTs have really been kind of falling off over the course of the year. I really am seeing a lot more interesting things going on in this space, and I think that it's something to watch, given especially how hated and how kind of downtrodden this space is. You've got a bunch of new technologies. The big one in Solana is called compressed NFTs. Solana, as I mentioned, already really fast, really cheap, really easy to use the chain. Compressed NFTs take that like 3 orders of magnitude even further. So you can go and mint tens of thousands of NFTs for a few dollars. Whereas you think about doing something like that on Ethereum, it's costing you tens of thousands, if not hundreds of thousands of dollars to do something like that. So what we've seen on Solana is you can bring entire blockchains to the Solana chain by creating NFTs. They did that with Helium and with Render, 2 recent applications, blockchains that migrated over to Solana. You've also seen different use cases. There's an application called Drip House, which various artists can go on and essentially drop free art as NFTs to users on the platform. And that has over 500,000 people who have subscribed to it. It's not generating any revenues right now, but potentially interesting kind of use case coming from this technology. Another thing you're going to see in the near future on Ethereum is called token bound accounts, which is making an Ethereum account, so just like your wallet address, and tying it directly to an NFT. So it's kind of like that NFT can go and own assets and own other NFTs even. And you can see a lot of potential use cases in like the gaming space, for example, where maybe you have a character and that character owns a sword and a shield and some weapons or whatever. Having that kind of ownership natively tied to an NFT makes that much easier. And then, Jeff, you mentioned AI. You can even take this a step further. You've got applications like Parallel, which are creating these games where the AI agents are just accounts on the blockchain. They own their own assets, and they're moving around independently within the game and just taking this extent really, really far, and doing some really cool things with the NFT space. Another one, maybe more a little tied to the real world, is IP NFTs, where you can transfer like legal rights with an NFT. And you've seen this in a space called DeSci, which is kind of an emerging vector within crypto, decentralized science, where you have these DAOs buying up intellectual property rights from scientists who are pursuing these kind of moonshot sort of scientific ideas. You've got these happening in places like longevity, in hair loss, in psychedelics research, just interesting spaces that are underfunded, not really getting as much grant funding from the traditional pharma companies and governments, but you kind of see this gap being bridged in crypto thanks to NFTs. So I think we're really going to see NFTs come back in the coming years, but take on a very different form than the way we saw them, in the past couple of years.
Yeah, and I think over the next, couple months here, we'll get in a little more deeper in the weeds into some certain sectors and applications that are really kind of showing some resurgent or even just kind of coming out of left field, some of the newer ones that maybe didn't even exist in any meaningful form 3-4 months ago. And we'd encourage people who are watching this and listening to us to send us your thoughts. What sectors do you want to see some data on? What other tokens? But I think one of the difficult things, especially as you're kind of ascending for the first time really in what feels like a couple of years, is figuring out what has real staying power and what is a flash in the pan. Obviously, it's very easy to look back on the successful sectors and applications that have worked, but in the moment, it's always hard. I think one of the ones we mentioned last month that we thought was on the rise was SocialFi, and I think, or you tell me if I'm wrong, but it seems like whether it really succeeds for sure in the future or not, it remains to be seen. But certainly, the fast pace that we saw last month and the month before dying down pretty quickly.
Yeah, definitely. I mean, I think in the last month, the market environment has really changed, where this was kind of the only thing going on. And now with other things rallying, I think there's just been interest lost here. This is definitely still a space that I think is interesting. There's a lot of iteration going on, even beyond, you've seen friend tech specifically multiply across other chains, but you're seeing some other stuff going on that's kind of iterated. You see like video streaming, software and other sorts of gaming platforms that are integrating this social fi element. So it's definitely a space to watch. But in the near term, yeah, we've definitely seen a fall off there with friend tech, which was kind of the hot thing last month. There's been a lot of issues there that I think are very fixable. Things like just the tokenomics, like how difficult it is for to access these various. So remember, this one was a sort of social system where you could buy access to chat rooms with your favorite influencers or people that you like. The difficulty was that those got very expensive very quickly. So once you got to 100 people within your chat, it kind of got out of reach of most people. So that was one issue. That it's been really clunky in terms of the user experience. But these are things that I think over time are going to be fixed, and there is a core element there, like a nugget of this still is very interesting in combining this kind of social media and social influence with the crypto financialization of everything.
And you made a good point there about the opportunity cost. A few months ago, it felt like there was nothing going on in the digital asset market in the blockchain world, and therefore this was the only game in town. And now, obviously, you've seen a resurgence, a little bit from NFTs, a little bit from gaming, a little bit from trading, and maybe that pulled a few eyeballs away from things like friend tech and some of the competitors to friend tech. But I think the biggest difference here, if you go back to 2019 again, 2020. You really never got off the ground with the applications. You saw a little bit maybe towards the beginning to middle of the 2021, things like gaming, like Axie Infinity that started to take off. But really the infrastructure wasn't quite there yet for any of these applications to really take off. Now, 4 years later, should we actually get some of these applications to take off, the infrastructure is there. The infrastructure is built, it works. So you have a much higher probability of some of these applications really taking fold. Again, whether that is from the gaming world or from social or from AI-driven compute and things like that. So again, this is a really data-friendly industry and data-intensive industry in terms of being able to analyze the blockchain data. And I think we'll be able to bring to light over coming months here of whether or not this really is kind of the beginning of another boon where we can see on chain the data that's supporting some of these applications, or if it's going to be a little bit of a flash in the pan where price got ahead of itself and maybe the applications didn't quite keep pace with the price action. So we'll see, and that's what we're going to do this on a monthly basis and try to bring it to you guys specifically what's happening on a month-to-month and week-to-week basis here. So we're going to call it here on that one. Appreciate you guys, everyone's time. Again, Nick Hotz from research, myself, Jeff Dorman, CIO of Arca. Feel free to reach out to us. Again, we want to make sure that these are higher level in terms of really kind of helping our audience understand this space a little bit better and where to get this information. Drop us a line. What do you like? What do you not like? What do you want to hear about? And we'll do our best to continue to bring to light what's happening in the digital asset space. So thanks, everybody.